Today, is it time to move beyond exit polls and tweets? The Property Imperative Weekly to the 14th of December 2019. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. In this week's edition of our News Digest, we decode recent events and consider their implications. As normal, we start with the international scene, but if you want to jump to the Australian section, the time is shown below. This past week, there have been perhaps 3 elephants in the room that needed to be addressed, all in a way trade-related. First, would a US-Mexico trade deal be reached? Second, would the US and China sign a Phase 1 deal before tariffs go up effective on December the 15th? And third, what of the UK election and how will it impact Brexit and trade? Well, we now have the answers to at least 2.5 of those questions, and perhaps the market will start paying attention to the fundamentals and more technical analysis again, rather than just the theatre. But in reality, not much has changed yet. And a hangover set in on Friday. The results of the market buying the rumour the US-China trade deal was coming, and then selling the news the trade deal is here. A US-Mexico deal was reached, with Mexican President Andrés Manuel López Obrador saying on Friday he expects the US Congress to approve the new regional trade agreement with his country and Canada by the 20th of December. And Boris Johnson won the UK election in a landslide, though US stocks didn't react. And the US and China agreed in the text to a trade deal which will result in the cancellation of the pending tariffs on December the 15th. There is still some drama that needs to play out, however, because it won't be signed until January and texts weren't even available to show the details. The detail includes evidently Chinese purchase of grains and other farm products, and a commitment to crack down on patent piracy and other measures. In return, the US agreed to reduce tariffs on $120 billion in products to 7.5% from 15%, and that reduction will take effect 30 days after the agreement is signed. And while President Donald Trump crowed about the deal, other officials, including economic advisor Larry Kudlow, were surprisingly wary of it. The deal will offer some confidence for business, Kudlow told CNBC Friday afternoon, but we will see how it works. And we'll see if the Chinese stay with their word. But in fact, the S&P 500 and the Dow Industrials ended little changed on Friday after hitting record highs earlier in the session as the United States and China announced an initial trade agreement, cooling tensions that had rattled markets. Meantime, Democrats in the US House of Representatives on Friday took Republican President Donald Trump to the brink of impeachment by approving 2 charges against him over his efforts to pressure Ukraine to investigate demographic political rival Joe Biden. A badly divided House Judiciary Committee voted 23-17 along party lines to approve articles of impeachment charging Trump with both abusing the power of his office over the Ukraine scandal and obstructing House Democrats' attempts to investigate him for it. Now, the S&P 500 was basically flat, although the index did finish with a record close of 3,160.8. The Dow Jones Industrial rose 0.1% on Friday to 28,135, as gains for Apple, Microsoft, JP Morgan Chase and others were offset by struggles for Boeing shares. And the Nasdaq Composite added 0.2% to a record close of 8,734. So the market ended the week with small gains, about 0.5% for the Dow, 0.7% for the S&P 500 and 0.9% for the Nasdaq. The market's malaise was mirrored by 2 commodities. Gold moved up on the trade deal's uncertainties to 1,480.2, and that's up 1% across the week. Oil jumped, with West Texas Intermediate crude settling above $60 a barrel for the first time since July, a signal that traders see OPEC's moves to cut production pushing prices higher. It settled finally at 59.77, up 1%. Interest rates shot up on Thursday as stocks rallied on the trade news, and they fell on Friday. The 10-year Treasury yield fell to 1.824% from Thursday's 1.899%, and the 3-month was at 1.564%. The Fed held the cash rate this week and signalled no change ahead, and the US dollar index slumped to about 96.7 late yesterday. It was the lowest level since early July, but it came back to 97.18, down 0.23% by the close. And we know that the Fed will be throwing the liquidity kitchen sink at the market over the year's end. See our post kitchen sink from the Fed up to $355 billion in the next month. The US dollar is softer against nearly all the world's currencies. The US yuan closed at 6.9895, up 0.12% on the day, but down 0.65 across the week. The Shanghai Composite was at 2,965.68, up 1.78%. And in Hong Kong, there were gains of more than 2%, and the Nikkei rose more than 1%. As a result, the MSCI Asia Pacific Index rose the most in 6 months, and Europe's Dow Jones Stock 600 rose 1.6%, the most in a couple of months in the European morning, but slid back later to end up 1.09% to 412.02. In the UK, it's the biggest margin since Thatcher in the late 1980s. Labour leader Corbyn resigned, and Lib Dem leader Swinson lost her seat. The Scottish National Party also turned in a strong showing, and it may be difficult to resist a new referendum at some point. Brexit will take place by the end of January, and the focus will shift to 3 things then. New negotiations with the EU over the future trade relationship, the state of the economy with fiscal stimulus promised, and Carney's replacement at the Bank of England. Carney is to step down at the end of January, and Shafik, a former deputy at the Bank of England, is seen to be a favourite to succeed him. The ASIC majority secured by Boris Johnson will bring an end to the political gridlock that has paralysed Parliament since Theresa May's lost her working majority in 2017. For Brexit, the result will almost certainly mean that the UK will leave the EU on the 31st of January with a deal in place. However, this is by no means the end of the road for pound volatility and risk events. We expect pound volatility to quieten down now and across the holiday period. However, in the new year, once the withdrawal bill has been ratified, pound traders will quickly turn their attention to the transition period, which is to last until the end of 2020 or thereabouts. This means that Boris Johnson has just 1 year to arrange the trade deals. That's an ambitious plan. The clear majority that Boris Johnson achieved could give him more scope for getting an extension to the transition period agreed to, and he would no longer be so dependent on the hardline Brexiteers and European Research Group. However, there is also the risk that Boris Johnson won't want to extend the transition period, given that his motto was "Get Brexit Done." And with such a solid majority, he has a clear mandate to do just that. The FTSE rose 1.1% on Friday to 7,353.44, and the pound US dollar rose 1.25% to 1.3326. Over in Europe, Christine Lagarde got glowing reviews for her debut press conference as president of the ECB. Her statement and answers did not spark much movement. Lagarde left no doubt about her inclusive and collaborative style, which is likely to help ease some ruffled feathers. The strategic review, which has already begun, is projected to take more than the next year or so, a little longer than perhaps expected. She seemed enthusiastic and a little upbeat by suggesting that several economic measures appeared to have stopped worsening, and that lending to non-financial businesses and households continues to grow. While there has been some press pieces suggesting officials are becoming increasingly sceptical of the merits of negative interest rates, Lagarde pushed back and argued that it has been an important tool. The Euro-US dollar was at 1.1122, down very slightly. And Deutsche Bank is considering deep cuts to bonuses this year. As Chief Executive Officer Christian Soen, it seeks to eliminate billions of euros of costs in a radical restructuring. Germany's largest lender may reduce discretionary compensation by as much as 20%, outpacing a 5% decline in the bank's workforce this year, according to a number of sources. Soen and the board still haven't made a final decision since the fourth quarter isn't yet over. Deutsche Bank shares stood at 6.827, down 0.8%. Hi, excuse the interruption, but if you're getting value from this post and have not done so, please consider subscribing to this channel or ring the bell for custom alerts. Plus, please consider supporting our efforts. You can make a one-off donation via PayPal, here's the link, or subscribe via Patreon for as little as $3 US a month or more to get access to exclusive additional content. Alternatively, you can also donate using Bitcoin. Here is the QR code. The links are in the comments below. I really appreciate your support, which enables us to continue to make more great content. Thanks very much. Now, back to the current show. And so to the local news. ASIC released their responsible lending guidelines this week, and they reinforced the legislative purposes of the obligations to reduce the incidence of consumers being encouraged to take on unsuitable levels of credit and ensure licensees obtain sufficient, reliable and up-to-date information about the consumer's financial situation, requirements and objectives to enable them to assess whether a particular loan is unsuitable for the particular consumer. They provided more guidance to illustrate where a licensee might undertake more or less detailed inquiries and verification steps based on different customer circumstances and the type of credit that is being sought. The updated guidance includes some new examples about a range of different credit products, including large and longer-term loans, credit cards and personal loans, small amount loans and consumer leases, and different types of consumers such as first-time home buyers, existing customers, strata corporations, high net worth and financially experienced customers. There was more detailed guidance about how spending reductions might be considered as part of the licensee's consideration of the consumer's financial situation, requirements and objective, and more detailed guidance about the use of benchmarks as a way to check the plausibility of expenses, as well as additional guidance about the HEM benchmark. And they spoke about more complex situations for some consumers. For example, the different situations of consumers such as income from small business, casual employees, new employees, the gig economy, as well as joint and split liabilities and expenses. And finally, ASIC also includes a selection on the scope of responsible lending, explaining the areas that are not subject to responsible lending obligations, such as small business lending, irrespective of the nature of the security used for the loan. Now, net, these are incremental changes underpinned by what they call the principle-based approach, and puts the acid on lenders and brokers to set their own boundaries. One point of note is ASIC expects a lender to be able to provide a summary of their assessment of a deal at the time of the transaction or later, but only on request. And this won't change the lending landscape substantively, in my view. The BIS this week revealed that Australians have the highest debt servicing ratio in the world and the second highest household debt to GDP ratio after Switzerland. And we discussed this in detail in our post, Households Hold All the Wrong Records. Yet despite the high debt and poor economic performance, APRA concluded this week that they will not need to impose higher capital weights on the banks via their countercyclical buffer, which remains at zero, despite a warning that it may be lifted later to help mitigate financial stability risks. When we looked at our analysis in our post, Relax, everything is just fine, says APRA, we argued that they are not taking the risks on board, and also they were mitigating some of the fines banks had been paying for their bad behaviour. More evidence, I think, that APRA is captured. And talking of behaviour, Westpac executive had a torrid time this week at their AGM as shareholders pressed for explanations of the poor behaviour of the bank. Former Chief Executive Officer Brian Hartzer resigned in November amid pressure over the incident, while Chairman Lindsay Maxted also announced that he will exit the company next year. It's unclear whether the next Chief Executive and Chairman will be appointed externally or internally. The bank intends to admit a large number of the allegations relating to Austrac and said it was determined to resolve the matter with Austrac, and also said on Tuesday it had refunded $86 million to shareholders who sought to withdraw from a share purchase plan after a lawsuit accused it of millions of money laundering breaches. Australia's second largest lender offered last month to refund people who bought new shares under the plan before the lawsuit. Some investors had said the offer was a move to fend off criticism about its transparency. And Australia's financial crimes watchdog Austrac filed a civil lawsuit in November accusing Westpac of 23 million breaches of anti-money laundering laws, including payments between convicted child exploiters. Another one to watch, is a landmark legal case that alleges cartel activity by Citigroup and Deutsche Bank employees, with JP Morgan witnesses appearing for the prosecution in Sydney. Many fear that the proceedings could lead to increased scrutiny and tougher measures from regulators worldwide. The charges stem from the August 2015 sale of $2.3 billion of new ANZ shares and the subsequent trading of some of the shares by two of the underwriters, Deutsche Bank and Citigroup. The banks failed to sell all the shares to investors and so purchased some of them themselves, and prosecutors say the banks struck an agreement to keep the unsold shares secret to support the share price, and in doing so formed a criminal cartel. Charges have also been brought against 6 former or current executives at the banks, 3 from Citi, 2 from Deutsche and 1 from ANZ. And Australian authorities filed criminal charges in June 2018 against the local units of Citigroup, Deutsche Bank and Australia and New Zealand Banking Group, and 6 bankers over the $2.5 billion stock sale. JP Morgan, who also advised on the 2015 deal, has been collaborating with the Australian Competition and Consumer Commission, the ACCC, since as early as March 2016 in return for immunity from prosecution, a pre-trial hearing heard last week. The banks and their executives have yet to enter formal pleas, but have said they will defend the case. For investment banks, the case will set a precedent in an area of financial markets activity that lacks clear rules and has never been tested in the courts. Bankers outside Australia fear a successful prosecution could prompt regulators elsewhere to take a fresh look at share sale practices. Cartel charges in Australia carry a maximum penalty of 3 times the profit made from the cartel activity, or 10% of a firm's revenue. Penalties for individuals found guilty carry fines of or a maximum 10-year jail term. The ABS property prices to December mirrored the CoreLogic data quite closely. No surprise, since the ABS used the CoreLogic data for their analysis. We discussed this in our post. Property prices are on the rise, but wait. And to make the point, other data sources are not as bullish on price growth, especially those based on settlement data alone. Realestate.com.au says Sydney prices, for example, rose just 0.8%, and Pricefinder, the domain equivalent, reported a fall of around 3%. So I continue to warn that people should not necessarily swallow the spruiking headlines on prices. And the same is true also of auction results. See our discussion this week with Fresh Canvas, the truth and lies of auction clearance rates. That said, the latest data from CoreLogic on home prices is still reporting upward movements, with Sydney up 6.26% over the quarter and Melbourne up 6.4%. And Sydney is still down from peak 7.4%, Melbourne down 3% and Perth down 21.2%. Auction clearance rates remained elevated, with CoreLogic reporting total auctions of 2,912 and 1,722 cleared, making, on my calculation, a clearance rate of 59.1% nationally and 58.9% in Sydney, plus 63.2% in Melbourne. However, they reported a 71.1% result, with Sydney at 73.8% and Melbourne at 73.2%, so there's still something strange here. And BlackRock said this week that the Australian economy is being almost entirely propped up by public sector jobs, growth and infrastructure spending. Consumers and businesses just aren't spending money, despite the Reserve Bank cutting the cash rate by 50% over the last 12 months. Google searches for Australia recession reached GFC levels in October, while the RBA is battling with the federal government over fiscal stimulus. BlackRock head of Australia Fixed Income Craig Vardy explained that there is an enormous amount of infrastructure spending going on at the moment, with quite a substantial pipeline. Really, it has been holding up growth in Australia for quite some time now. That is clearly a concern. Strip away the government proportion of real GDP and you're not left with much at all, he said. It remains very important for the RBA that infrastructure spending continues, particularly after 3 rate cuts in 2019, which have failed to drive economic growth or see the Reserve Bank hit its inflation employment targets. The concerning thing about employment is that almost all of the jobs created over the last 12 months have been in the public sector, Mr. Vardy said. There have been almost no job growth in the private sector. That is quite concerning. And BlackRock is predicting the RBA will cut rates to 50 basis points in the first quarter of 2020 and again 25 basis points in the second half. Reserve Bank Governor Philip Lowe had already flagged that 25 basis points is the lower bound for the central bank. Once it reaches a cash rate of 0.25%, it will enact quantitative easing by buying Australian government bonds. And the IMF published their latest preliminary findings at the end of an official IMF visit or mission to Australia. They recommend preparing for risk from a rapid housing credit upswing by introducing loan-to-value and debt-to-income limits and possibly a sectorial countercyclical capital buffer targeting housing exposures, plus transitioning from a housing transfer stamp duty to a general land tax to improve efficiency by easing entry into the housing market and promoting labour mobility, while providing a more stable revenue source for the states. Such reforms could be complemented by reducing structural incentives for leverage investment by households, including in residential real estate. They warn growth has been supported by public spending, including on infrastructure, and net exports, which have held up well despite headwinds from global policy uncertainty and China's economic slowdown. However, domestic private demand has remained weak amid subdued confidence, with a widening output gap. In addition, the ongoing drought has been a drag on economic growth. Wage growth has remained sluggish, reflecting persistent labour market slack and inflation, and measures of inflation expectations have dropped to below Australia's 2 to 3% target range. Following a marked adjustment over the past 2 years, housing prices have started to recover, particularly in Sydney and Melbourne, and more analysts are warning about the poor performance of the banking sector, with Westpac shares trading at a 7-year low following the alleged breach of anti-money laundering laws and 3 of the 4 big banks recently cutting dividends or franking credits. Investors should consider cutting their exposure to the banks to avoid erosion of their wealth and income. The outlook for profitability is not good. Low interest rates are likely to persist for a long time in Australia and abroad. High levels of household debt in Australia will inevitably hamper future growth in earnings from mortgages and as households save more. Household debt sits at around 190% of debt to income, higher than in most other countries. While most households are comfortably making the debt repayments, any shocks to the economy, such as significant rise in unemployment, could push more households over the edge. Add to this other remediation costs for the banks associated with poor customer outcomes and regulatory non-compliance, which according to Reserve Bank figures have amounted to $7.5 billion across the financial sector over the past 2 years and are still rising. That figure does not count Westpac's likely escalation in remediation costs, lawsuits, and potentially record-breaking fines following Austrac's prosecution of its alleged 23 million breaches of anti-money laundering laws. And APRA has also imposed additional capital requirements on the major banks to account for poor risk management practices. All of these are weighing on banks' ability to make money, and this is sobering news for shareholders. Dividend cuts and falling share prices and profits are alarming outcomes for many Australian investors whose portfolios have significant exposure to the Big Four, which represents around 1/4 of the S&P ASX 200. In other words, if you hold a blue chip portfolio or invested in an active or passively managed Australian equity fund that tracks or is benchmarked to the ASX 200, 1 out of every $4 is likely to be invested in banks and therefore vulnerable to the risks they face. And in the last month alone, to the 4th of December, Westpac shares were down 10%, and over 5 years they've fallen 25%. NAB shares were down 16%, and ANZ 23%. Commonwealth Bank has lost a relatively modest 0.6%, but these are dire financial outcomes for shareholders. And finally, to the markets, the ASX was up 0.42% on Friday to 5,590, while the financials index was 6,029, up 1.4% on the day, but down 3.05 over the month. Over the same period, the Bank of Queensland was down 14.62%, Westpac was down 8%, and NAB was down 9.01%. The Aussie bounced this week up to 69.07 on a weaker US dollar, up 0.54% across the week, and the Euro Aussie dollar cross also rose to 1.6014, up 0.43% on Friday, but flat across the week. The gold Aussie cross was up 0.43% on Friday to 2,127.46, and the Bitcoin Aussie cross was at 10,434, up 1.71% on the day, compared with the Bitcoin US dollar, which was at 7,224 and up 0.82%. Next week, we get the MYEFO, so it will be interesting to see if growth, inflation or employment are down forecasts, but I'm sure the government will still engineer that promised surplus. And finally, before I go, a quick reminder that on Tuesday the 17th of December at 8 p.m. Sydney time, I'll be running our next live stream where we'll be updating our scenarios and take questions live. You can send them to me beforehand via the DFA blog, links are below, or ask real time via the online chat. Mark your diaries. And so to conclude, despite being close to the end of the year, there's a bunch more data to come, and of course we'll be there to cover it next week. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.